Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Man, it is, I'm headed to vote. And, by the time you listen to this, we will have a new president. Don't have any idea who it's going to be. While I care, because obviously I have pretty strong opinions about, and you guys would know that. I do share my strong opinions. However, this time, well, every time from a business perspective, it doesn't matter. I just figure out a way to pivot and keep my business running and flourishing, and I will do the same thing this time. However, it does matter, and I hope you voted, and I hope no matter whether your guy or gal wins, I hope that as a country afterwards we can come together and try to eliminate the divide that our illustrious media and our politicians would prefer that we continue to have. And that is not the topic I'm going to talk about today. It just happens to be what I'm doing. I want to talk about loans today, as I've had a bunch of questions about the different types of loans and why would you use them? Why would you use one over the other? When to use them? And so I want to really briefly talk about the different types of loans there are and why you would use one over the other, et cetera. So the first type of, this is only for investment loans. For investment loans, there's conventional loans, which is what we think about. It's those are the 20% down Fannie Mae loans. They're the ones that you have to basically get a blood draw, DNA sample. I mean, they're such a pain in the butt to get. However, they typically have the best rates in terms. They're a 30-year fixed loan. They typically have the lowest rates, but they're a pain. In addition to that, they also have a loan limit. And, each person can only get 10 of those loans. That number moves around. It is, I think been as low as 4. It's been 8. It's been 10. It's currently 10. I think everybody knows what those are. It's 20% down for a single family home. Move into duplex and fourplex or triplex. It's 25% down to qualify for those loans. There are some investor loans out there, conventional, that you can do maybe 15% down, but they're so expensive. It's not worth it, in my humble opinion. So it's basically 20 or 25% down. That's pretty much where we live on those particular loans. But get ready. They literally, financially successful people who have a high credit score I tend to see them get very frustrated in the process because they ask for so much detail. And these people are highly qualified and they just don't understand why in the world they need to nitpick every single little thing. Well, the reason that they're doing that is because they're selling the loan off typically in a bundle, and they're selling those off into the secondary market. And the buyers in the secondary market have, they have all their boxes that they check. And if the loan doesn't check all those boxes, then that loan, the mortgage broker has to keep that loan, or it's called a buyback. They have to take that loan back and hold it because they've messed up. So the underwriting process for those is very vigorous because they want to be able to sell those on the secondary market without any problems at all. So like I said, they're a pain in the butt. Best terms, but pain in the butt. Next, you have debt service coverage ratio loans, or DSCR loans. So if you ever hear anybody say DSCR and you don't know what it means, it's a debt service coverage ratio loan. We've talked about them before on the podcast. I just want you to understand the difference between them and conventional, the pros and the cons to them. And then I'm going to throw one more kind of wrench or wrinkle into the scenario. So DSCR loans, I used to say that DSCR loans don't care about the individual. That's not true. They do care. However, they only care about a couple of things, and they're pretty easy things. The first one is your credit score. So they want to make sure that you pay your bills. That's pretty easy. They pull your credit. They have tiers just like conventional loans do. So if you're top tier, you get the best rates, best terms that they have. The second thing that some of them care about is if you own rental properties. In other words, if you have experience owning rental properties. Now, internally at RP Capital, we don't need that because we have our DSCR lender knows our book of business. Everything we sell is professionally property managed. Nobody is trying to become an individual landlord. But the reason that that's in place is because if you're buying an investment property and you're going to be the landlord, in other words, you're going to do the management yourself, they want to make sure you know what the heck you're doing, because that piece of the business, as we've talked about before on the podcast, is critical. It is absolutely critical. And by the way, in a future episode here, maybe in a couple of episodes, I am going to give you a download of what I learned having spoken at the National Association of Residential Property Managers, or NARPM, and from being there as Lineage, our new tech company. Talked to tons of property management companies, spoke to the main group, and learned a few things. So look for that coming up in a future episode. So back to DSCR loans. So they want to make sure you know what you're doing. If the property is professionally managed, I think you probably get around that hurdle. But those are really the two things that they're looking for. Those are the two things that they're after. Outside of that, really what they're doing is they're underwriting the property itself. So they're underwriting the financials of the property to make sure that it cash flows enough to cover the debt service on the property, which hence the name, debt service coverage ratio. Each one of those lenders has a ratio. It's almost always over one to one, like 1%. It's almost always over that. So a 1-to-1 ratio would be if your debt service is $1,000 and your income is $1,000. If all of your income and your expenses meet that $1,000 and you net $0, that's a 1. It's usually more than that. They want you to have some cash flow. Okay. Hopefully that wasn't too confusing. That was a really bad description of what that is, but debt service coverage ratio loans. Now, why would a person want to use them? Typically, they don't have as good of an interest rate. They do have 30-year fixed rates, and they also have 10-year products which have a little bit better rates. So they have different pools of money. But the reason that you would use them is because they're much, much faster. You can get one of those closed very quickly. Again, because they're underwriting the property and not you. And they're much, much easier. So if you have a complicated financial situation, it's just so much easier. You're not having to give DNA, sell your children and everything else that you have to do for a conventional loan. And most recently, over the last many, many months, they've been pretty competitive with your traditional loans. So why wouldn't you use them? They're much, much easier. The terms are very, very close, very similar. Yeah, they're just not a pain in the butt. So a couple of downsides to these. They almost always have a prepayment penalty, okay, where a conventional loan doesn't. So if you're planning on selling a property in the first 3 years, might not be the best thing for you. But if you're planning on holding the property for longer than 3 years, which almost everybody that buys from us is, then it's not that big of a deal. Fantastic product. I love them. And most of our people love them as well, just because of the convenience factor. Now, there's some other really cool things that we're doing, which I'll share in some future episodes that we've just been able to do with our lender. and we've had some pretty good success. So another tease, that's 2 teases in one episode, which is really cool. So I'll do an episode on that coming up as well. Some really cool stuff we're doing with DSCR loans. But the final thing about DSCR loans that I wanted to talk about today is that they have an interest only option, which doesn't exist with conventional. So if you're trying to maximize your cash flow as opposed to have principal reduction, because obviously if you have an interest only loan, you're not going to have any principal reduction because you're only paying interest. But it does substantially increase your cash flow. Now, there's usually a little bit of an interest rate bump. I think it's typically about 0.5 point, but you're not paying principal, which, on a $250,000 house with a $200,000 mortgage and, roughly like 6.5% interest rate, that's a couple $100 a month of more cash flow. So if you were going to cash flow a couple $100, now you're going to cash flow $400. So there's just some flexibility with these debt service coverage ratio loans that there isn't with other more traditional type loans. They're easier. There's plenty of different ways that you can package these things up. 10-year, 30-year ARMs, which, right now I don't think you need to do because interest rates are actually pretty decent. But there's a lot of options. And then you've got the interest only option if you're trying to maximize your cash flow. They're a pretty cool tool to have in your arsenal. And especially if you have a large portfolio and you bought them over the last few years and you bought them with local banks. I just talked to a friend the other day who had done this. Man, definitely should look at doing them because you can do portfolio loans with them. And those portfolio loans, you can usually get a lower interest rate on those portfolio loans than you can on just a single individual loan. And you can do cash out refinances with debt service coverage ratio loans, and you can take a package and really increase your cash flow. It's happening a lot right now because most people were buying over the last couple of years. They were buying with between 7 and 8.5% interest rates, and now with a point or two, you can get down to 6% with debt service coverage ratio loans, and you can do them as a portfolio. So if you own 20, you can do one loan with 20. It's fantastic. So another thing to keep in mind, and on those portfolio loans, you still have the same options, right? You can lower your interest rate by having a shorter term on your debt instead of 30-year. If you don't plan on keeping them, you can also do interest only periods. They have a 10-year interest only. So if you wanted to just cash flow as much as you could for the next 10 years, you can do that. There's so many options. And I happen to know of a couple of other things that are coming down the pipe that are going to be really, really cool. And as soon as I know that they're for sure, I get back on here and add them to a podcast so that you guys know about them. Some really, really creative things coming from that world because that world is specific to investing. All of you will benefit from understanding what those are. Okay. So if you are sitting on a bunch that have higher interest rates, you can refinance them and get into a different mortgage if you'd like, and increase your cash flow. If you're buying properties towards the end of the year, again, I know I said that already, get on it because, trying to close property before the end of the year is difficult enough. You shouldn't make it more difficult, I guess, by trying to do it in the clutch at the end of the year. And then you've got all of the different options. So DSCR versus conventional. I love DSCR loans, especially when the rates and terms are pretty even. So till next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.